Hi, this is Randy Finney with the Right Side of the Chart, and today is Friday, January 18th, 2019. This is the second part of two videos covering the broad markets, the S&P 500. We'll look at SPY, QQQ, and then as I did in the first video, we'll cover the 11 sectors that comprise the S&P 500. Because as I say, a market or a sector or an index is simply a sum of its parts. And in this case, these are the top components. So we'll go through the charts. And what this video will focus on is the intermediate to near-term time frame. So we'll look at the weekly and daily charts on each one. I should be able to wrap this video up quicker. The last video, if you didn't catch it, you may want to catch that one. That paints a bigger picture, longer-term stuff. And again, not actionable. It's a monthly charts, or those are the monthly charts we covered. These charts are more actionable as far as trying to time or scale in and out of positions. And so we'll go from there. Let's start out with the S&P 500, and before we get into the charts, which is technical analysis, let me talk on fundamentals real quick. If you've watched the videos for the last few months leading up to the highs back in, depending on which index, at least October is where we really started to fall off a cliff. At that time, I was calling for a sizable correction in the market to at least, revisit the lows earlier in the year. And that's what happened. Now, as we started heading down, I spoke to the fundamentals on this, and I said two things would happen. Number one, I said the Fed, who was hawkish at the time and had planned several more hikes, I said, mark my words, they will backpedal on those comments, become more dovish, which they have, and that's been a big catalyst for this rally here. And the other thing I said is, as we started to fall, you would see economic forecast revised downward, and that did happen as well. Now, as we started to get towards the bottom, again, those were the comments I made up here to justify this. As we started to get towards the bottom, in these videos I spoke about how the economy was not falling off a cliff. This was not 2007, 2008, that the banks were in much better shape. The economy was in really good shape. We have a lot of economic indicators that are still strong, and this was overdone, and that would soon be the talks at the time, which it is now. Now, that's what they're saying. At this point in time, again, anything is possible. Everything, or I should say the majority of the things I'm looking at in the charts tell me that this is most likely a bear market rally. May have some more upside to go after a pullback here soon. But what I believe will happen soon is reality will once again set in. So there have been some of the economic indicators have rolled over, and soon you'll probably hear talks that things are softer. The outlook, in other words, is not as rosy as it was back here at the top. And so we've already retraced about half of the correction. And so therefore, as a pendulum often does, it swings too far, usually in the opposite direction. Swung too far down here, certainly, and I believe it's swung too far here. In fact, this line in the middle tells, or at least gives you a visual of where I think the pendulum has swung too far this time. So I think we come back down here, and that's why I put that QQQ short trade on. And I still think more than likely we'll get another thrust higher, at which point then we'll be able to recycle in for some longer term, for the next leg down, for some swing shorts that we can tuck away for at least several weeks, possibly even a couple months. So just to reiterate that, I'm a firm believer that the charts price in the fundamentals, and the fundamentals will follow, and the headlines and sentiment will. And if you've seen nothing else in the last few months, you've seen the fact that sentiment can turn on a dime. Everybody was bullish, thinking the market was going up to new highs. I did videos back here saying that I struggled. I looked, I couldn't find anyone in the media back here talking about any recession in the near-term horizon. Once we started doing this, everyone was then talking recession. Now they're saying, oh, well, recession's way off. Sentiment will ebb and flow with the stock market. That is one thing that I can guarantee you. And I can also tell you it can turn on a dime just like it did here, and it did here, and it will again soon. I know this rally seems unstoppable, but that's just something to keep in mind. So I like to get ahead of the charts, and sometimes it entails getting in early, and sometimes there's a big difference in my book between early and wrong. Sometimes I'm wrong. What's the difference? Well, early is, for example, I'll take QQQ for a second. I don't want to spend too much time. I already covered that trade earlier, but here's a great example. Wrong is if QQQ goes over 168.90, I'm wrong. Right, if it hits these targets, then I'm correct. Even if it takes 3 weeks to get there, even if we round out slowly and then turn down. If we go up higher and then turn down, then I was a little early. If we fall from here, spot on. And if we go above 168.90, then I'm wrong. So there's a difference between early and wrong in trading, in my opinion. All right, now let's dive into the chart. So we're already on SPY, so we'll just start there. There's your uptrend line, primary uptrend line right there. There's a breakdown back test. Everything else I've talked about, and again, I probably should cover it here. This would be the max bounce target area around 280 and change. It's around 2,800 on SPY or S&P 500. Although, as I said, the chances are probably fall a little shy of that level. There'll be a lot of eyes if we get there. So I'm still leaning towards something along these lines here, a little, correction here, tradable correction. I define tradable as something you can get into that will last more than just a day or, a few hours or maybe a couple days. Those are the unofficial trade ideas that go in the trading room, pullback trades, long, short. But official trades on the front page are always swing trades, or at least intended to be swing trades. Those are trades where the holding periods are typically measured in weeks, sometimes months. Sometimes they do close out in a day or several days if it's an explosive move and the targets are hit right away. But that's for the most part what we're looking at on the front page. So that's the S&P 500. Again, I think we've overshot to the upside here. A lot of trend indicators remain bearish, intermediate, longer-term trend indicators at this time. And let's look at QQQ real quick, and then we'll dig into the sectors. QQQ, like SPY, you had divergence on the RSI here. Overshot to the downside, and we're rallying back. We'll put a trend line right here. I have a similar trend line on XLK that's actually been hit, I believe, but I want to point out that potential trend line right there. And let's see if we can have anything off the highs. Yeah, we could do that, and then that one's been taken out today. These aren't very well-defined trend lines. And the reason for that is I like to see at least 3 distinct reactions on a trend line to validate it, because any 2 points, like I just did here and here, can be connected at random. We didn't have a reaction here. We hit that trend line yesterday, closed on it, and kept going through today. So that's not a reaction, at least the way I see it. So this trend line right now, and it's minimal, 3 reactions. So there's a potential target. But like I said, the bigger picture to me is there is just a confluence of resistance, a lot of overhead supply to work our way through. And we're about into the middle of that area now. So we're about in the midpoint of my bounce target zone. We're below the lower end of it and still about halfway up to the upper end of my bounce target zone there for QQQ. And of course, the point of this video was to go over the 11 sectors within the S&P 500. As I go through these, again, keep in mind that I'm doing these in the order of the highest weighted, which is XLK. These are the percentages right here. XLK, the technology sector. So we'll go down. We'll start with a weekly chart on each and then jump over to the daily chart. So that'll give us the intermediate term and the intermediate term and near term outlook. Although daily charts are still intermediate term, give or take. We're not going to get down to the 60-minute charts in this video. This is sort of a broad brush overview of the markets here. So starting out with XLK, which once again, the largest component of the S&P 500, nearly 20%. So 1/5 of your returns in the S&P 500 here, and about 3 times that in the NASDAQ 100 are coming from the tech sector. So that's certainly, if you're going to watch just one sector, not that you should only watch one sector, but if you are going to, this is a sector to watch because it will have the biggest impact on the market. There is a downtrend line, as I mentioned a minute ago. We've run into it now. We don't have a reaction yet, but let's see if we do today. I suspect we will. Otherwise, I wouldn't have put that QQQ short on. I see a lot of reactions as I go across this line here. Again, I mentioned this. I can draw trend lines, a whole bunch of horizontal resistance lines, because for the most part, this is just a lot of trading has occurred in this area in 2018. So far, we're powering on through it pretty impulsively. Got to give the market that. But we're only about halfway there, so there's still a lot of overhead supply in tech stocks. Let's see if we get a reaction here. The PPO is still very much down in bearish territory as a trend indicator. I use that 9 EMA. That's the white line. When it crosses below this 0 line here, It's the last of the two to cross, so it helps filter out whipsaw signals. So there's XLK at resistance on the daily. I meant to start with a weekly. I'll just toggle back and forth. One thing I want to point out as I get into this video, you'll notice on the weekly chart, I've set it to a 6-day period. Normal weekly chart is 5 days, meaning a candlestick represents 1 week of trading, which is 5 calendar days, of course, Monday through Friday. A 6-day period adds 1 extra day in there. Have to do that. This is my go-to platform for when I do the videos, TC2000. And when you go to a weekly chart, you can only go back 10 years. So what happens is it just cuts off the lows. And so as I do these videos, I want to include the end of the last bear market, the beginning of this bull market. So some of these divergence lines I have may be slightly off since I've modified the, added an extra day to these candles. Just wanted to point that out. But for the most part, you'll see the divergences, everything I had drawn on the weeklies. So XLK, what do we have? We have a series of couple uptrend lines during this bull market. There was one very well defined. We broke below it, and then we had a flash crash in the tech stocks and XLK right there. That's that long candle. And so most of my trend lines right now that I've focused on pick up on the early 2016 lows, or in some cases on QQQ and XLK, the mid 2015 lows. Very well defined trend line. That's right up there as far as how well you want to see a trend line defined. In other words, lots of reactions, clean reactions off the trend line at multiple points. The more reactions you have, the more valid a trend line. And then it broke down, as you can see, and the $1,000,000 question, and I can see both sides of it. Bulls say, well, we've had a heck of a correction. Tech stocks dropped 25%, XLK roughly. And as I said, I think it was overdone. I think it was overdone at this point right here. That's where the waterfall sell-off started kicking in. But we've already come back to that point now. So we're a little bit back above there. Again, there's a lot of upside momentum right now. We still haven't even tested these 200-day moving averages in a while. If I don't make mention, when I'm on a weekly chart like I am now, you'll see a 40-period exponential moving average. On a weekly chart, that's the same as a 200-day. It might get thrown off a bit here because we're on a 6-day candle, but it's roughly the same. This will look very similar to a weekly chart. What else do I see here? Well, as I said, this trend indicator, the PPO signal line, when it's above 0, the 9 EMA, the trend is bullish. And for technology, pretty much it's told you throughout the entire bull market, you're in a bullish trend. The primary trend is bullish. During the bear market, the signal line was below the 0 line. Right now, we're solidly below. We crossed below, and we're still below there. Let me flip over to a weekly chart and just show you what it looks like there, deep down below that level right there. We had a little whipsaw signal here. You can call it a whipsaw, but again, as I mentioned, this was a bear market in XLK, so not really a whipsaw signal. The only whipsaw signal there was really the upside move. And remember, too, and I mentioned this at the time, this was largely a sideways market where the market traded sideways. A lot of sectors and indexes went into a bear market mode or dropped more than 20%. And many consider that a bear market. So you want to call that a whipsaw signal or not. It's this time around, what's different is we're deep below the, well below the 0 line, whereas before we've had a couple brief whipsaws down below there. Let's go back to that 6-day period. I already started with the daily, so now we can go on to the next sector, which is XLV. XLV is the healthcare sector that comes in at about a 15.2% weighting in the S&P 500, and just a pretty clear looking chart to me. This is a well-defined uptrend line. As I mentioned, when I draw my trend lines, I look for the maximum number of reactions off either the candlestick bodies, that's the fat part, and or the shadows or the tails and wicks. In this case, you can see a lot of reactions here. This comes off the 2009 lows. So this is the entire bull market uptrend line for the healthcare sector. At no point in this chart did we close down below, print a solid weekly close down below that trend line until recently. And like I said, the better defined a trend line is, the more technically significant. So when we broke, we didn't just limp on down through there. We had one of the biggest candles in years to help validate that was a breakdown. And right now we're making a perfect back test. So you want to know my opinion? This is an objective shorting time, short entry for XLV, and it could possibly prove to be, the final counter trend rally in XLV. I still think there's a little more upside in the market. And, what will tend to happen if I'm right on that and we're heading anywhere near 2,700, 2,800 in S&P 500, it will give a tailwind to all sectors. The way the market works is there's still a tremendous amount of indexing. I think that bubble is slowly being unwound. The indexing bubble, we call it. A lot of money too much money going into index funds. But what happens when there's inflows into the S&P 500 index funds like SPY or your S&P 500 index fund, your mutual fund? Every dollar you put in there gets spread proportionally among all these sectors, just like this. So you put a dollar into the S&P 500 index fund, again, whether it's your 401k or SPY, you're putting 15 cents into the healthcare stocks. You're bidding them up. So my point is, you want the highest probability entry. Wait till if you want to swing the next trend down in the healthcare stocks, you may be a little early now. In other words, maybe we back test for a while. Maybe we pop back above that trend line. But I do want to point it out. Putting all that aside, maybe the market stops tomorrow going up, and that would be, again, it's an objective entry. My confidence isn't high enough to put this on as an official trade yet, but it may be soon. Let's look at the daily chart. And there it is. This is a trend line here on the daily chart off the 2018 lows. Pretty well defined. A lot of reactions. Very impulsive breakdown. Probably comes in at the same as that weekly trend line and near perfect back test. We also have, which I like to see, horizontal price resistance. You see a lot of reactions here. I'm going to circle them all. A lot of reactions. Reaction from below right there. A couple reactions from above. And so we have intersecting price resistance, we're a hair above it, and a back test of an uptrend line. And then if it powers on through there, there's still a lot of trades that occurred here, a lot of overhead supply that the healthcare stocks would need to work their way through. Trend indicator is still bearish as well. XLF financials. We're starting out here on a daily chart because that's what I was just on. 25.90 give or take. Pretty significant support or resistance level. Reactions along here, reactions here, here, here. So same story. If we pop it, you can see I have additional levels overhead. I've highlighted we've hit a lot of levels and we've just gone through them recently. Doesn't mean we're going to continue to do so. And statistically speaking, the more overbought we get, more extended the market gets, the more likely you are to finally have a reversal off one of these. And because of the extreme overbought conditions, when we do have a pullback, because the rubber band is now getting very stretched, it's likely to be a pretty sharp, quick pullback. On XLV or XLF, I'm sorry, probably a gap backfill right here. We have a gap that would be a minimum pullback target. We don't have any sell signals as of now, but again, we're coming up on resistance. Let's look at the weekly chart. So far, the weekly looks okay. I mean, well, let me clarify. The financials have been in a bear market since back here. They've dropped they peaked in January, well above that high. And the drop was, I'm just going to rough measure it for you if I can. To move that trend line, get there to there. It was about a 26, 27% drop. Okay. So about a 27% drop, and the thing is we hit this trend line here. So that is bullish. Here's multiple reactions. You can see I'm circling all the reactions. Overshot it by hair, completely normal, momentum fueled overshoot. Plus, it was a overshoot of a very well-defined price support level as well. So far, so that's it. You have a correction and a bounce off support where it should have bounced. As I often say, the initial tag of support. And what I mean, not the very first, technically speaking, this is the initial tag. I'm referring to when you haven't visited that support level in quite a while, the initial tag of support very often or almost always produces a reaction. And that's what we had here. Look down below. We have trend indicators, again, that signal line on the PPO. We have it trending. In fact, we're going back now, what is this, 12, almost, yeah, over 12 years or so. So we encompass the previous, well, this is the end of the last bear market back here. Let me zoom in a little bit. There we go. Now we're over 12 years. We can see 1, 2, 3, 4 times where that signal line has been trading below the zero line. and we have it here in the bear market leading into the lows. We had a bear market right here, a very clear bear market. That was about a 30, almost a 40% drop in the financials, and we had a bear market here. So is this mere coincidence? We're deeply into bearish territory on that trend indicator. So in the past, there have always been bear markets. Oh, technically this one was so far, but we're still below that level now. PPO is looking to cross up, but sometimes you get what looks like a bullish crossover, and then boom, it goes back down. You have another low there, and that's what I think will happen. Like I said, it's hard to quantify it. I think in a video the other day I mentioned that maybe around late February. I'm targeting around February 20th, give or take a couple weeks, for my max upside targets in the market to be hit. And so I think we get a correction before then, and then one last thrust up. XLC up next at 10.3%. We can't look at a weekly chart on XLC because it hasn't been around long enough. It's a new sector in the S&P 500, the communication sector, replace the old telecom sector, plus some other companies thrown in there. But we do, when we go to the daily chart, it has traded enough now to have a potential downtrend line. We'll call it potential because we're now at the potential third reaction. We haven't reacted off there yet, but there's reaction 1, reaction 2. So if we do pull back from on or around these levels, as I suspect, that will give us that third reaction. And then this sets up a trend line to watch. We also have a trend line forming here off the lows. Pretty steep trend line, something along these lines. So let's watch that for a solid break, and that may trigger a sell signal there. And next up would be XLY. This is consumer discretionary. Let's see. So we're coming up on a pretty a decent, I wouldn't call it a solid resistance level. It's decent around 107.50 or so. We had some reactions back here, almost a reaction there, and it's not super well defined. We could move that line up a little. I probably should have it more of a resistance zone, if you will, which we're at the bottom of right now. Just eyeballing this chart, we might be able to draw a trend line here off this these reaction highs. So again, something else to watch. And like everything else, we fell right to support. I mean, this was just a beautiful display of technical analysis. This was, these are old notes from my chart before. I had a sideways consolidation zone, the top of which was obviously resistance. We broke out, very impulsive breakout. You can see just string of green candles after the breakout of that. And that tends to happen. The longer you consolidate in a sideways pattern, you're building energy like a coiled spring. And that was the breakout following that. We didn't really stop until this point. But that was an extended run. What happens after very extended runs, the more stretch they get, the harder the rubber band snaps back. So that's what we're looking at here, I think. Divergent low, everything else. So you fell to support with a bullish divergent low, no-brainer trades in my opinion. I mean, we were at support here. We could have bounced there. We didn't. And once that support gave way, that's what technical analysis is. And this is why I point out objective entries. This was support. Maybe we could have bounced there. We didn't. But once support's broken, it then becomes, it's broken. It should be resistance on the way up, and it was. You can see here you had an opportunity there. Boom, we hit it, and we came all the way back down on this candle here. We went down the next day. So you had a reaction there, and then boom, the next leg up. That's XLY. Weekly chart. There's your trend line right here off the lows. The way I let out this, that capitulation type sell-off, but we have quite a few reactions on this trend line. I think it's pretty valid. A little more upside before we back test it. You can see simple watch, rinse, repeat stuff. Look for these divergent highs. 21% drop, 11%, 18, 17, 22 so far. But again, what makes this one different? Well, those other two are the recent ones. Not so much that one, but this one here brought us back down to the bull market uptrend line. But all of these corrections were above trend. And then we started really hugging this trend line, helping to define it. And now we broke down, we consolidated for a while, tested below and fell. So that to me indicates that the primary trend has been broken. So most optimistic scenario right now is a back test of that trend line and then a continued move down, and that's consumer discretionary. XLI industrials, there's your uptrend line off the lows on the weekly chart. Back test right there. We have resistance above at about 71.80 or so. Trend indicators are bearish. Let's look at the daily chart. We're at resistance right now. Let's try to color this line up. Okay, so you can see again you had reactions here from below. Near tag there was also an uptrend line, a couple reactions here recently. So like I said, sort of sloppy, if you will. You get just a lot of sloppy trading. And again, when you take a step back and just go back for a while, this looks like topping action here with a breakdown below that zone. I'll go back to the daily charts. I just want to make sure I covered XLY, which was a sector I covered before discretionary. I can't recall if I hit it on the daily chart, but there it is. You have a downtrend line plus some resistance there coming up on the discretionary stocks. So, all right, we just covered XLI, XLP. And remember, as we get down the line here now, XLP is a 7.18% weighting consumer staples. And you have quite a few reactions along this level here. There's a big gap to note. We overshot it there a little bit, so we're coming up on resistance on XLP. Let's look at the long-term chart, the weekly chart. XLP actually looks better than most. A couple things have happened here. You know, my targets for the next major leg down on the broad markets is the top of that trading range or bear market, whatever you want to call it, back from 2015 to early 2015. XLP consumer staples have already hit and exceeded that level, whereas the broad market hasn't. Here, let me show you real quick on SPY. Okay, so there's SPY. So there's where I think we're going before all is said and done, somewhere around here down to about right here. And you can see we're far from it. Whereas XLP, we already hit that level. What does that tell me? It tells me a couple things. Consumer staples, these are defensive issues. As the name implies, are staples, things you need. Gillette's a consumer staple company. During a recession, you don't stop shaving. You're still going to buy your razors as often as you did before. So those companies tend to hold up at least during a recession. Now, nobody wanted them in the last few years. That's why they've already fallen and had their own bear market and come in and actually move back down below those 2015-16 lows. Why? Because everybody wanted to own the FANG stocks. They all wanted Apple, Amazon, Facebook. And we saw what happened recently. That proved to be a crowded trade. But the point being that this one from a weekly chart looks better than just about any other sector in the S&P that I'm seeing. And it should, because where we are in the business cycle, if I'm correct, and we'll start to see the economic indicators now continue to roll over, then you'll see tech and high momentum, high growth stocks underperform, and you should see relative performance in consumer staples. What does that mean? Well, relative performance means they're not immune to a recession or especially a stock market downturn. Why? Well, one of the reasons I said before, they are a component of the S&P 500. So when you see continued outflows of those funds, they're going to come under forced selling, even if it takes them below their fair valuations. They may become cheap, but during a bear market, that's the thing about stocks. They continue to become cheaper and cheaper and cheaper. But with that being said, I would certainly overweight this sector if you don't short the market and you want to have longs and want to put your money in areas that have potential to go up but also have the potential to fall a lot less than the broad market. This would be one of them. Nice, strong, bullish divergence on the weekly chart. They've already had a heck of a correction. Downside from here, well, let's look at upside. 53.20 is an upside target. There's some resistance. And before all said and done, I do think we'll come back down here to the 47.32 level, probably some point in 2019, maybe 2020. Let's see, did I cover that on the daily? I think I did already. XLE, energy stocks, all I can tell you there is they're coming up to some pretty significant resistance, just like oil is. Of course, they're going to track oil very well. Heck of a run off the lows, bullish divergence on the RSI and everything else. And again, they track crude prices. Here's a weekly chart. Here's your uptrend line breakdown. And again, you can sort of see from the weekly, it gives you a better perspective of those trading, sideways trading zone right there. That went on for a couple of years, and we're coming up to the bottom of that. So a lot of resistance overhead in the energy sector, just like in the broad market. And utilities, although it's a small weighting, only 3.18% in the S&P 500. what I see here. And these are, yes, they are defensive issues, but keep in mind they fell off a cliff in 2008, and they could do so again. I'll tell you, I'm not, even though they're defensive issue, I'm not crazy about this chart. We had divergent high right here. I should extend those lines. There was negative divergence at this point. We had a correction that took us down below our bull market uptrend line. They've been back testing since, and recently were rejected off the back test, and that set up this smaller uptrend line right here, or this wedge type pattern. You can see that. Again, it had divergence because that was an equal high right there. We broke down, and when you zoom in tight, it looks to me like they're bear flagging. You have an impulsive move down, that's your flagpole, and this little consolidation period is actually called a bearish pennant, similar to a flag, just takes the form of a pennant. And that would, if it breaks to the downside, probably take us to these recent lows down here. That's XLU. Let's look at it on a daily chart. And on the daily chart, you can see they're coming up to quite a bit of resistance. We have a gap right there and a reaction low, reaction high, reaction lows, reaction lows. It's a little sloppy trading, but there it is. XLRE, these are the REITs. They trade well to trend lines and to the technicals. You can see uptrend line, break, correction. You had an uptrend line here, you had a divergent high at the highs, tell you to get out or prepare for a short. When the short signal, sell signal came on a break of the trend line, sharp correction. Very well defined uptrend channel. This was pointed out at the time, parallel, rising price channel, breakdown, boom. I think we even had a trade on that one if I'm not mistaken. But I'll tell you, this is not healthy price action. This is very erratic trading in the REITs, and it's just not good overall. You know, investors, long-term investors don't like this kind of volatility. They're getting stopped out. There's just wild trading. I don't have a very strong opinion, but I can tell you right now, we're coming up to some resistance right there. We had some reaction lows, but I don't have a strong opinion on the REITs, so let's move on. Plus, it's only 3% weighting in the S&P 500. It's not going to really make a big difference there. And then finally, XLB, which is basic materials, right up to a pretty significant resistance level. It's only a 2.71% weighting, but you can see this was resistance to that point. It was support right there. It was support right there. That support broke, waterfall sell-off. And then we had, of course, the volatile trading last quarter. So we went up and down through there, gave it up once again. Finally, after the second time we gave it up, we had that capitulation sell-off. Put in nice bullish divergence. This was one of the better looking sectors off the lows with divergence on both the PPO and the RSI. And that divergence has certainly played out and then some, but it's now brought us back to that resistance level. If they pop 53.63 by a fair amount, next stop, probably about here. It's not a very well-defined level, so take it with a grain of salt, but around 54.60 or so. And then last but not least, this is the weekly chart of XLB, and you can see the divergent highs, the trend line breaks. So you can see just a series of cyclical bull and bear markets within a secular bull that we've been in. And there's your one trend, nice rising wedge, negative divergence, breakdown, correction. Set up in the next uptrend line, rising wedge. I had a secondary trend line there. When that was broken, there was your correction to that point. That set up in a bullish divergent low, positive divergence, set up for the next rally. We broke down there and we're below trend. We had a secondary trend line that broke down as well. The other things I noted is the PPO is for the fourth time since before the last bull market even ended. Right back here we have the trend indicator. The PPO is solidly below the zero line, indicating a bearish trend, just like it did back here. It told you the trend was bearish here, told you the trend was bearish here, told you the trend was bearish here, and just recently flipped into bear mode. So to me, it's just a matter of how much more upside, most likely to that point there, before we continue down. Okay, guys, long video, but I wanted to cover a lot. I'm covering 12 sectors plus the market on 2 different time frames in this chart. And again, I think that helps to paint the bigger picture. And again, you want to put the biggest weighting if you're factoring this into your own analysis, if you're going to replicate these charts, in the same levels that I showed you as resistance on the upside. If we don't fail there, and if you think, and it is possible this market has more to go, look for those levels to get taken out. And again, do this collectively. Don't just look at one sector. But if you're looking at XLK, watch its resistance levels. It should cap any advance, get taken out. Especially those to the upper end of the bounce, not anything close by. Right now, these are levels, again, I'm looking for just pull back here and probably most likely another leg up. But if we start getting up there to or past that 2,800 level on the S&P 500 and then comparable levels on these sectors, and we go on right through there, then that opens a door that maybe this just was a correction in an ongoing bull market that will go on to be the longest in history. But as of now, especially based on what I covered in that chart earlier with the monthly chart, or the video with the monthly charts, there's just too much evidence telling me that most likely the market saw its highs back here in late 2018. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.